Really?
Hi, everyone. Thank you so much for joining us today. I'm Sarah Van Wagenen. I'm the Business Development and Marketing Coordinator with TMC. Today, I have with us Laird Nosuli, the CEO of iEmergent, and she will be diving into HMDA Data Central Edition. We're just going to let everyone have a few minutes to hop on here. If anyone has any questions at all during the webinar, please feel free to drop them in the chat and we will address them. We are also recording today. You will be receiving a follow-up email with the recording, as well as a link to the recording on YouTube and our podcast as well. And if you have any questions, please don't feel to reach out to either myself or Laird, and we will get started shortly.
All right. One more screenshot and we are good.
Wonderful.
And although I have, of course, have the dog he should be fun. All right. This. Yeah.
All right, everyone, we'll get started here in a few moments. Just a quick TMC announcement as well. We do have our early bird registration ending for Denver tomorrow. So if you haven't registered for our next conference in Denver, I'll also drop the link in the chat and you can register as well.
Okay. Looking at ready here. There we go. All right. Let's one more. There we go. Got had all right. So you ready for me, Sarah?
We are ready. Go ahead and take it away.
All right. Okay. Let me share my screen here. And I don't know why you've allowed screen share, right?
Yes, should be at the bottom of your screen.
And all right. Oh, I Zoom all the time.
It'll be at the bottom in the middle in green. Should say share screen.
Okay, it was grayed out. Okay, we're good now. All right. I just want to make sure you don't see all of my stuff. Can you hear me?
Yep, we can hear you and
All
we
right.
can see the London
See the
coverage
screen?
by.
And do you see my little okay. Well, thank you for your patience while I was getting this set up. By the dog barking here, and obviously Zoom wasn't working right. But thank you guys for joining me again today. Today I'm going to talk about the Central States. So last week, I think it was last week, I talked about the eastern third of the country, and today we're going to talk about the not just the Midwest, but the entire central area. So if you look at the top of this PowerPoint slide that we're looking at, these are the states we're going to cover. And of course, as I mentioned last week, we could spend hours digging into different pieces of this information. And one of the things that's challenging is knowing what level of detail makes the most sense to look at. And so obviously, if we want to look at the whole United States, which we did at the beginning, we can get that really the big picture and what is the mortgage market doing over time. But today we're really going to focus in at a state and a little bit at a metro market level and look at some higher level trends, only because if we really wanted to dig into every MSA and every trend, we'd have, a day's worth of things to talk about. So interestingly, as when you think about the U.S. mortgage market, you really have to think that we don't really have one. It's really a compilation of, if you're looking at census tracts, 85,000 different census tracts. But then you can think about, okay, there, instead of 85,000 tracts, there are 3,143 county markets. And there are 900 in some and metropolitan markets. And every one of them behaves differently. But if you look at the chart we're looking at right now, the 2004 to, all the way through our 2020-25 forecast of loan origination activity. So that we're looking at this particular case, blue, which is the purchase, the light blue, which is the refi, and then the little green up there is the label for what those two added together. So sort of what is our total mortgage loan origination, both historically and, a couple of years of forecast look like. And what's interesting is that even though the numbers will vary and there'll be some differences from market to market, the general trend line is going to be similar. And I was playing around with this chart, at a state and metro market level, hoping that I would find an example of it that was really interesting, but most of them looked like this. So I think if you look at this, you get a good sense of what's happened over the last, I guess almost now 2 decades. And you can see that, focusing primarily on these last, 2018 to 2023, what felt like a terrible year, obviously this big drop from 2021 to 2022 when we lost so much refi activity. And then, further, another drop, not quite as steep in terms of just that huge size of the refi drop. But, we went from 6.9 million loans to 4.5. You see that there's a $1.5 million drop. Not million unit drop, and then about 1.1 million units in purchase. So really, if you think about how this drop looked, the bigger story this year isn't the continued refi drop. It is that we did see a little bit steeper purchase drop than we originally were, I guess, hoping to see. Just a little bit of information about what we're projecting. Our forecast right now has it pretty flat for 2024, and then starting to pick up again in 2025. So what has been this sort of this long-term trend line, which is what I really look at with this purchase. We're going to be below it, but I think that by 26, 27, we should be back up to what would be that market long-term trend. Same thing, a little bit more volatile when we look at loan dollars. That's really, I think a lot of that has to do with that as the units change, when we look at dollars, it's impacted a great deal by what average loan sizes and home values are doing. So some of these drops and the fact that, the increases are going to come a little bit more quickly because we're still projecting and seeing increases in home values. So our dollar number is going to sort of turn the corner more quickly than our unit number. And again, these two charts are at the national level. But now we're going to dive into the central region. And as I mentioned, that, that big 24, 26-year chart looks the same. So, the shape of it looks the same, whether we're looking at an individual state or at the country. So this chart, instead of going back to that and revisiting that, what I wanted to look at was that this last 6 year, the 2018 to 2023 sort of snapshot. And one of the things that we see with this particular chart is looking at the difference in loan purpose. So the other one I was focused on only purchase and refi, but in this particular chart, I wanted to capture the whole picture. So purchase, refi, and then home improvement, and also the home equity loans. And the reason I wanted to capture that was because of the change that we see here when rates changed, we saw a flip from a lot of the transactions like the cash out refis, rate term refis, but mainly the cash out refis kind of moved to a new place. So they moved to this home improvement and other, the home equity space. And so before in 2021, 6% of all loans were that kind of that, I call it that HELOC, home improvement bucket. But now as we move into 2022, it was 15%, and that bumped up to 18% in 2023. So that's just shows you that how the rate environment can shift, not just the actual dollar numbers, but that what we call that that distribution of loan purpose across different years. So you can see that right there, and I think that's interesting, and I think it has another impact if we were looking at this specifically and focusing then on market share. The fact that we have this home improvement and the HELOC space did help some of the depository lenders maintain some share. So the market share for those types of loans is, heavily, bank and credit union and not driven by the IMBs. But on the other hand, the IMBs continue to, if we look at market share across the board, really sort of dominate the purchase environment from a market share perspective. And I get into that in more detail when we really look at that balance by state. So if we kind of stick with that for a minute and look at the states that we're going to talk about today, I wanted to give a sense of rankings, but I wanted to look not just at the size of the opportunity or the size of the market, but also a look at the speed of that market's growth. So if I'm looking at all of those, and I think it's 20 states, here they are alphabetically, and this is, all loan purposes. So what does that loan count look like? But you can see how the rankings change if we look at just counts alone. So Texas, probably no surprise considering this group of states, Texas had the most loans overall. And then when you look at growth, though, you can see that I looked at two different time periods. One is that snapshot, 2018 to 2023. And then the other time period is, on the right here is the last year. So, 2022 to 2023. And you can see that and they're all negative growth numbers because we are looking at total. So when you look at the bigger time horizon, Texas, number 3 in terms of growth. So it lost the least, but again, try to not think about it in terms of the loss, but just how quickly it's growing or slowing. And Oklahoma in both situations, both time periods, though, did lose the least. So that I thought that was an interesting thing. And then Colorado was, kind of at the end of the tail end with growth. When you're talking about loan purposes. And I think a lot of that has to do with not so much what's happened from 2018 to 2023, but where these markets were in 2018. So when you get this and you look at this, always keep in mind that starting point and why there might have been differences at that point. Looking at same way at the dollars, you see a little bit of a different picture. Texas is still, by far the largest dollar market in this region. But then if you look at growth, we see that, Arkansas actually grew a lot in dollars from 2018 to 2023. And then, from 2018 to 2023. And then again, we didn't really see any markets that grew in dollars from 22 to 23, but a lot of that has to do with the fact that we lost both, or all loan purposes in terms of that loan count. So this is probably a function, a great deal of increases in property values and home prices, whereas this is really a function of the fact that the unit counts in the last couple of years couldn't make up for, or the increase in the price couldn't make up for the drop in the loan units. So then I also looked at that distribution by purpose, and I was hoping to find something a little bit more interesting here. And what this is really looking at the rankings by each individual loan purposes percent of total. So in this particular case, we're looking at home purchase. So Texas had the highest purchase ratio, so 77% of all, again, we're looking at all loan purposes, not just purchase and refi, but 77% of the transactions in Texas in 2023 were purchase versus Wisconsin saw only 47%. So that's a pretty wide difference. When we look at refi, home improvement and other, you do see that, Wisconsin, with less purchase, had a much more robust refi market, continuing to 2023, and then much higher percentages in terms of home improvement and HELOC. So kind of moving on and looking just at the state by state, we're not looking at anything differently than what we were just seeing, except we're going to be looking at it visually here. So what I wanted to show in this particular image is, using the heat map concept. So when we're looking at states here, so blue states have less opportunity, either loans in this case, dollars in this case, and the red states have more. And you can see here that these colors change, not a whole lot, but a little bit, when you're looking at the difference between loans and dollars. So this becomes more pronounced when we look at the heat maps for metro markets, because that's where we can really see that difference in market size that's based on transaction count, and the size of the market that is driven by transaction count, but also is impacted by home values. And so again, not really a surprise that Texas is red in both cases. But then you see, oh, okay, well, Colorado is red in the dollars. Well, it's because with some of the high cost markets in Colorado, home prices are higher. It's driving that up from a dollar perspective. Even though if you were, to sort of look at these different tiers, Colorado is going to be a lower tier, like this yellow color, when you're looking at just loan counts. And this is, again, that purchase and refi mix. If we change that and look at, this is the same look, but we're going to do that same shift and say, okay, instead of looking just and ranking just by size, let's go over here again and rank by growth, both from the snapshot horizon and then the year-over-year horizon. And when we're looking at just purchase and refi, and we kick out those other loan purposes, you can see that we have a few changes in growth. And Kansas comes out on top when you're looking at loan count for purchase and refi. And Texas, of course, maintains the #1 across the board from a size perspective. And here's that same look by dollars. You can see that, we had Kansas was here before, but when we look at it by dollar growth, the smallest decrease was actually in Indiana. And again, Texas still, from a dollar perspective, dominates. And then even with growth, because of those markets, dominated in that 2018 to 2023 time horizon. So kind of looking now, what I think is really the most important thing to talk about, not just from the last year, but really looking at the markets that we're going to have this year and next year. What happened with purchase originations? Because purchase really, again, with the 3-year outlook, a lot of business is going to be driven by purchase. So thinking about and understanding the purchase opportunities in your market is really going to be, I think, the basis for a sustainable performance over the next couple of years. So I did take a little bit more time breaking that down and looking at, okay, what are the top purchase markets in loans? What are the top purchase markets in dollars? And what are the top purchase markets specifically in average loan size? And that's where you can see that Colorado average loan size pop up to the top, which is what was driving that switch from Colorado being a yellow, if you will, yellow tier state in terms of, loan count, and moving to a red, tier. So like the top tier when you're looking at dollars. So this particular slide, again, when you have this PowerPoint, I think it'll be fun to look at, what is the driver of these different rankings. And again, you're going to see that a lot of it is going to be driven by that average loan size, especially when the differences in, especially when we're looking at growth, differences in loan counts aren't significant, aren't as impactful as what that does and compounds with these different average loan sizes. So again, kind of that same look. What happens to origination units when we look by state? This is the visual, and this is the rankings in more detail when you look at growth. Same thing with dollars, a little bit more detail here. Here's the, the overall rank, and then there's the growth ranks. And then the same thing, when we go to the next slide, we're going to have that same look and look at combined by MSA. So if you look at, this is the MSA picture of this one, the purchase and refi originations by state. So if we go back down here, you can see how much more variation there is. But what's interesting is if you look at where the big, or the red, orange, and yellow MSAs are, they're going to correspond to the red, orange, and yellow states pretty closely. So again, probably no surprises about which of the markets jump up in terms of, MSA level total loans, meaning purchase and refi loans. Largest market in 2023 was Dallas, followed by Chicago, Houston, Detroit, Minneapolis, Denver, San Antonio, St. Louis, Austin, and Indianapolis. That's your top 10 when you're looking at loan count. If we move that and look at dollars, some of the same ones are there, but that ranking changes. So Dallas is still number one with about 45.4 billion. And then you have Chicago, Houston, Denver, Austin, Minneapolis, Detroit, San Antonio, Indianapolis, and St. Louis. But there's some swaps in there about between Detroit and Denver. They switched, and a couple others changed places. However, when you go deeper into the list, you'll see that some new ones pop up when you're looking at originations origination dollars, and a few drop off when you do that. Average loan sizes are pretty, there's a pretty wide range, in this central area, and some of it obviously is driven by like Jackson Hole has the highest average loan size. Overall, it was, over $1 million. All the way down to number 40 out of, I think it's like 250, is Taos, and that's 297. So a wide range at a market level, in terms of average loan sizes. And again, that's a combined average loan size of purchase and refi. So then going back to purchase totals again, I wanted again to focus more here, look at size and that 2022 to 2023 change. And so here you can see a big difference, even though we were looking at those 20 states, when we start looking at so many metropolitan areas, the number one county in size is typically not the number one county in growth. And so here Dallas was number one, as we saw earlier, in purchase loans and in the purchase and refi mix. But then when you look at how much change, what does change look like? Dallas dropped down to number 8. And what that means is that from 22 to 2023, Dallas only lost about 12%. The decrease was about 12% in purchase loans, where the market that saw the smallest decrease was Odessa, and that was only 5%. But in general, you can see that there's a wide range, but not as wide a range of differences in decrease as when we're looking at that combined purchase refi or all loan purposes against each other. moving to the purchase dollars, you can see, again, Dallas is leading the pack with some variations in the purchase dollars. And then we look at average loan size, big change again when we're looking at that. I think this one is even more, you can kind of see that the purchase and refi average loan sizes, I think that was they tended to get a little bit lower since the refi numbers were lower. But when you look at just purchase average loan sizes at a metro market, you've got these two high cost markets, Jackson and then Edwards, Colorado. All of those Colorado markets right up there in the top 10, which is what I mentioned when we were looking at it. And down to, again, focusing just on purchase, Chicago's, average loan size, purchase average loan size is about 310. So we got wide range, but definitely some differences that are worth looking at. This was something that I really spent a lot of time on and am interested in. And that's, what does it look like from the perspective of market share when you're dealing with different lender types? So for example, I mentioned that, we saw a shift in the market share when we're looking at all loan purposes, because banks and credit unions do so much more of the HELOC and home improvement business than the IMBs do. But if you take that out, which we're doing here and just looking at purchase, it's interesting because you can see when you're looking at the percent or the count of institutions, banks are by far, in most states, either more than half or just under half of the institutions. But when you look at market share and what percent of either purchase apps or even purchase loans, that shifts dramatically. And you can see that this is where IMBs, even though they may have, 37% to, I guess the range is about, what's this? Well, 26% to, it looks like 44% from a count perspective. That translates into as high as 72% of apps, right? And 74% of apps in markets like Texas and Colorado, where the IMBs do a lot of that purchase business. And so credit unions, that's also very interesting. Credit unions are sort of state, the impact or the role of credit unions is different from state to state. I'm in Iowa, and Iowa has a very active credit union space. So, 26% of all of our purchase loans in Iowa were originated by credit unions. You can contrast that with, Montana or Arkansas or, Wyoming, really all of them. None of them get as close to that as what Iowa has. And you can see that there's, maybe 10 states across the country where it just seemed to be more prominent. And obviously, when you're looking at the Midwest, you have Iowa, Wisconsin, and Michigan, where there's a I guess much higher than average percent of the apps are being originated or taken by credit unions. So that's what this chart looks at. It's really interesting when I dive more deeply and look at that chart from the perspective of different race and ethnicities, different loan types. That shifts quite a bit then. I'm going to skip and talk just quickly about MSA level rankings for race and ethnicity. Now I'm not going to get into denial rates in application behavior in this, because I think it's more important that we just talk about the importance of the BIPOC markets for growth. Okay, as we look at these maps, keep in mind that not only nationally, but at a market level, some of the best opportunities for growth are going to be with your Black, Hispanic, and Asian, and also like sort of multiracial, multi-ethnic groups. But this really is, if we were looking at speed of growth and compared, like Asian growth to overall or non-Hispanic, purchase loan growth, Asian, Black, and Hispanic all grew more, or I guess in some ways we should say decreased less than non-Hispanic whites. So this is important information to know, not just which are the largest markets for the different groups, so Dallas, still comes out on top. But what's equally important, and I have, on two different slides here, is the rankings in size, but also in penetration rate. So yes, Dallas is a really big market, but when you go to the next slide and you look at rankings, still one of the top markets from a percentage perspective. Then you see Austin pop up, Ann Arbor, Columbus. They may not have the counts that you'll see in some of the biggest size markets, but they have the penetration rates. And where that's important is it means that in some ways they're that much more important to growth in that market than it is just looking at just pure size. So keep that in mind. And you're going to see it's pretty different. Obviously there are going to be the big markets like Dallas and Chicago that are going to have growth, with all markets. But then when you go to look at, the Black purchase loans, you can see, again, the markets that we expect. Then you start looking at the penetration rates and you see, hey, there's a lot of markets where they may not be huge, but they have a high percentage of their purchase loans that are going to, these different groups. And what's interesting is if you look at how things are changing over the next, or should be changing over the next couple of years, and if you look back to 2018 and look at how 2018's penetration rates have changed from a BIPOC perspective, they're all increasing. So when you're thinking about setting goals and about where you want to go and how you want to look at and prioritize your markets, keep in mind that from a market segment perspective, these are growing markets. And soon, 2, 5, 10 years down the road, going to be a much bigger part of your business than maybe they were 5 years ago. Just kind of a plug for why housing equity isn't just about equity. It's also about, and doing the right thing, it's about doing the right and smart growth decision. So keep that in mind when you look at these numbers.
Quick question in the chat,
Sure.
Laird. Are credit unions trending up?
It depends on the market. I did see that in the markets that I mentioned, they are trending up a little bit. That if you look overall at that loan, if you look at all originations, absolutely they are, because they did do, some of the HELOCs and the home improvement that might have before been captured, in a cash out refi, some of that, we've seen that shift, and they are doing more of that. But there are some markets where they're growing. The markets where they're strong, they actually got stronger. And then there are a couple other markets when you look nationally that show credit unions getting a bigger share than they had 3 years ago. Of course, then there are some places where they stayed flat. But I do think the impact, the role of credit unions is more impacted by, the market or the state than you see with the other ones. I mean, I'd say that, but then we did see that, banks, there are some markets in some states, it does seem like it does seem to be more state directed than MSA directed. But there are states that just seem to be, have a higher percent of depository business. Just like when you look at it from a broker perspective, there are some states where there are just more brokers than there are other states, in other states. But in general, I'd say that credit unions were more likely to gain share than banks or IMBs in markets where they weren't already strong. Does that make sense? Hopefully. And when you look at the market share by lender type, and you look at it for the race and, different race and ethnic groups, it's important to keep in mind that some of that is guided by product. And so it is true that a bigger percent of purchase loans to we'll use black borrowers are the the number one place where we see a big difference in a higher market share for IMBs than banks and credit unions. That does seem that may seem counterintuitive, but when you really look more deeply, it's because of the fact that the IMBs utilize the government loans, FHA loans, at a higher rate than, or just use it more than particularly the banks. We are seeing an increase in the especially again market by market. Credit unions have a bigger role with Black borrowers than they have in the past, but we don't see that increase carrying over it with credit unions to Asian borrowers. Asian borrowers have a much higher, banks have a higher market share in what we call a loan to or application to lender ratio than IMBs and credit unions. I think some of that is just, if you kind of look at the details and the characteristics of these loans, Asian borrowers have a higher average loan size, they have a higher income, and they tend to not need or utilize FHA financing as often. Therefore, that sort of translates into, working more often with banks. And also, I think some of that comes from, there still is a homeownership rate gap between Asians and non-Hispanic whites, despite the fact that the income is higher and the average loan size is higher. But a lot of that has to do with cultural issues and, how people or, how different groups use credit. But it really is impacted by the relationships, the banking relationships with deposits. It just tends to be a relationship that happens more easily. Again, this is speaking very broadly for all Asians in all markets, but that just has a higher bank market share than either Hispanic or Black borrowers do. And lower, and what that corresponds to is then lower denial rates as well. So not just the share from the perspective of the loans, but there's a higher application share and a higher pull-through rate with banks and Asians than with Asians and specifically IMBs, but also with the exception of a few credit unions from that perspective too. So I can't remember how long am I supposed to be done?
We can go as long as you want. We can go till 3:45.
Okay.
Usually
All right.
30
Well, I mean, again, if ever, I know that everyone has a lot to do, and if anyone has to jump off, certainly makes sense. The only other thing to talk about would be, I didn't get to that for the Central like I wanted to. I think I'm going to go back to look at, yeah. So the other thing I was looking at was the difference in denial rates, by race and ethnicity. And I will say that I was it's always troubling when you see denial rates for underserved groups be so much higher. But when I was looking at this Black denial rate here, specifically in the Central, some of these states had, like a 28% denial rate is really high, and that's what Arkansas had. And if you think about why that is, you start looking at their income levels in some of the markets in the state that that may have a higher denial rate, and you look at who the lenders are and what home values look like. And so Arkansas, I can say that 28% higher denial rate. Well, when you look at the median incomes, and sort of that socioeconomic standard for quite a few groups in Arkansas, you have greater number of people that are already LMI. And so that denial rate being higher than, say, the Colorado denial rate, a lot of that's driven by the distribution by income for each of these different groups. So first I was like, oh, what does this mean? But then I looked more and paired it with some of the demographic data, and then you kind of see a different picture that comes to play. But I think what's interesting though, again, whether you're talking about all purchase or Black, Hispanic, Asian, the differences in what we call the fallout rate between states and markets is pretty significant. I mean, I like to you think that, oh, it's not going to be that different, but this shows, it paints a different story, that there is a market driven impact for how many loans are actually originated. And if you again look at race, ethnicity, income, and then you add in home value, that's where you start seeing this kind of look really different, because I think like Iowa, 23% fallout. The states that have the lowest fallout rate are the ones that have the lowest home value to income ratio. So, I'm in Iowa, I can tell you, we have relatively low home prices and relatively, higher, and I'm not high incomes, but for the home value and the home price, incomes are relatively high. And so that's where you really see these lower fallout rates versus markets where, it's high cost. And yes, they may be, the incomes may be higher. Like if you look at, we don't have San Francisco in here, but if you look at some of the really, really high income markets, that looks like it could be promising until you see just how high the home values are and the cost of living. And then you realize that it's not so much the income or the home value, but the relationship between the two that impacts how easy it is to to get into a home and get started with that. Well, it's 2:45, so I think that that's probably all I have time for. We definitely have a lot of things we can talk about. If anyone's interested, I think I've mentioned that before, feel free to reach out, and happy to share the decks, happy to go into more detail about specific markets, specific lenders, all of that. So
Wonderful. Marcy dropped a question in the chat looking for a copy of the deck. Yes, we will send out a follow-up email to everyone with a recording, as well as the deck. There also is next week on Tuesday, the 23rd at 4 p.m. Eastern, diving into HMDA Data West Coast Edition. So if you're interested in joining us then as well, that is up on our event calendar. I will also drop the registration link in the chat, and Laird will be joining us again then.
And I do want to tell you, any of you were on last week's. I haven't sent the deck yet because I did find some little errors that were troubling me. And so there'll be a revised deck that I'm sending to Sarah that she'll be sending out just to make sure every single one of the states that are on the map or on the in the table have the right numbers with it. So that's why you haven't seen that one yet. But this one's ready to go, and I'll just forward it to her. And again, let me know if you have any questions. Thank you,
Thank you,
Sarah.
Laird. Thank you, everyone, for joining us.
Bye.
Thank you. Bye.
Bye.